Hello, and welcome back to another week of your Mortgage Market Movers Weekly, where we will detail everything that's been going on in the real estate world to keep you up to date. First and foremost, we hope that everyone that celebrates had a very, very happy Easter, and hopefully you are not in a chocolate coma. All right. Last week wasn't a huge week. You know, it's kind of the same stuff that's been going on. We don't have a huge week this week. There was some important data that did come out last week, and we'll go over that. I think we are going to go back to the charts this week. You know, last week we tried I tried to keep it short, but it was still, about 4 minutes long. I don't think that grabs people's attention span anymore. Anyway, we're going to go back to the charts today. So just so you know, the 30-year fixed rate as of last week, it jumped up about 20 basis points, 6.83 from a 6.62, something around there. You know, the rate had been coming down about like 2 basis points or so each week. And, it's a big jump. So we're going to go into a little bit of why that might have happened and what can you do so you are knowledgeable moving forward and maybe not the best time, but a good time to buy. All right. We'll let you know when it's a good time to buy, maybe a good time to sell, maybe a good time to refinance, maybe a good time to pull some equity out of the home. All right. So we are going to hop into it and let's get over to the charts. We are back at the charts, the good old US 10-year yield. And it is not doing too hot. So, we use the US 10-year yield as a proxy for mortgage interest rates. And we want to see is the yield heading down or is it heading up? And that's going to let us know where our interest rate's sitting. We had this high back January 15th, 4.809. We can probably go back and we might do that later. And we'll take a look at where the 30-year fix was. Usually it's about 1.5% to 2% higher. Okay. Now, it dropped all the way down on April 4th to 3.864. And now it's sitting at 4.364. That's, kind of a jump for sure. Every time you see one, these are called candles, and every time you see one, this is just for one day. So in one day, I want you to look at the range of what the interest rates could have been. So all the way 3.863, and like I said, not in mortgage interest rates, right? This is the 10-year yield, but the way that lenders are going to price is based off of this 10-year yield. Okay, so we just want to look at the volatility. One, let's look at the volatility over here, right? Okay. So this volatility right here, when I say volatility, let's look at the range of this candle, okay? It's not anything crazy, It's really not super crazy. We might get some bigger ones like here. This is a little big, right? But look at this. This is wild, okay? A high just in one day of 4.221 and a low of 3.866. It looks. It'll tell you over in the left, actually. Let's see. A low of 3.871. It changed 4% in one day. That's crazy. I mean, like I said, this is kind of a bigger body. This was a change of 2.9% in one day. So I really, really, really want to drive this home for you if you're listening. The market is so volatile right now that if you like a rate, you can wait. You can for sure. But when things have this range, it could have dropped 4%, but, it could also go up 4%. So you are really taking a risk, right? And when we look at the macroeconomic environment, it's just not a great look. And, usually what we'll do is pull up the bond market. Let's actually go to the bond market, though. Let's look at that. This is what I use as a proxy for the bond market. And this is just going to tell us what the bond market is looking like. Are people buying or selling bonds, right? And we're talking about U.S. Treasury bonds. So back in rates are going to be higher when this is lower. Okay, inverse relationship. So, like I said, back in January, it probably was fairly low. Look, I mean, it was climbing up, not anything super crazy, but it was climbing. All that just dropped. Okay, now when we compare this to the stock market, right, the U.S. equity market, they typically have an inverse relationship as well. So you are going to see U.S. stocks climb and you're going to see the bond market fall and vice versa. The reason for that is bonds are typically less risky, right? A bond is an IOU from the U.S. government, and we hopefully don't want them to default and not be able to pay back debt. Now, what's been going on in the market, of course, is the trade war that's been going on. I want to say about a third of our treasury bonds are held by foreign investors, Japan, China. And if they choose to sell, all that selling pressure, we don't have to get into how like the market really works, but just basic economics, right? When they're selling, it's going to push it down, of course, because there's more supply, less demand. Okay. Economics 101. So we really don't want to see the selling of these bonds. And we really don't want to see Japan and China and other countries sell their treasury bonds, because that is going to push the 10-year yield up, which is not great for mortgage interest rates. Okay. I mean, really, as rates climb, of course, and I always like to look at it like you can always refinance. Is it a pain sometimes? Yeah, for sure. But you can refinance when the rates get better. So when we look at the overall market, anecdotally, I think that the inventory has been sitting for a good bit longer, especially here in Florida, and the rates are high. So that is demand is definitely down. I will say maybe, right, it might be a good time to buy. You can always refinance later. You can't get a lower purchase price later. So, I guess just a little rant for you there about the current state of the market. Anyway, before I get too far down the rabbit hole, let's go over and just kind of look and see what's been going on. Okay. So it is April 21st. Let's look last week. Not anything crazy that came out last week. Retail sales is interesting. It lets us see our consumers still spending. I want to say core retail sales just takes automobiles out. Let's see. No automobiles. All right. So this is month to month. Last month, it was up 0.7. There was only a forecast of 0.4%, but it was up 0.5%. So that's good. People are still out buying things, which is contrary to the consumer sentiment reports that have been coming out, because they have been really, really, really incredibly weak. So this was one of the things that Jerome Powell talked about when people do talk about recession. A lot of people are worried about it, but they aren't spending like they're worried about it. So hopefully that doesn't go down, So we want to keep an eye out for these retail sales. I do think that'd be important to look at moving forward. Retail sales month over month, when you do include automobiles, up 1.4% from last year's 0.2%. So people are buying cars. All right, let's see. Unemployment, lower unemployment claims. That's always great. Building permits, number of new residential building permits issued during the previous month. That's up. That's good. Housing starts, annualized number of new residential buildings that began construction. That's down. Honestly, here in Florida anyway, and I'll talk about Florida because that's the market that we serve, right? We serve other states, but that's, where we're based out of. Anecdotally speaking, right? Homes just have been sitting on the market longer, so do we necessarily need to be building new homes? I don't know. I'm sure that there's data out there that we can look at to actually see, how long inventory has been sitting, but I don't think that that's anything to be worried about. Now, let's see this week. We do have new home sales. That's going to be Wednesday at 10 a.m. That's going to be interesting to look at. We want to see, are these homes selling? The forecast is 682, which is up from previous months. This is monthly, I believe. Yep, monthly. 676, and this is in thousands. 682 is the forecast, so we are hoping for a beat on that. We want to see that people are still buying homes. Let's see. Unemployment claims, that's always good to look at. Durable goods is going to look and see what is going on like the manufacturing side of things. I want to say that that's like this is purchase orders from manufacturers. Let's see, hard products that have a life expectancy of more than 3 years. So we want to see, are manufacturers, are they still, buying these durable goods, and how are the tariffs going to impact that? The PMI will also kind of show us how tariffs are going to impact things. So those are definitely things to keep an eye out for. We don't have a ton going on this week. I mean, really, the color of this, when it's red, that's important to the market. But what's important to the market isn't necessarily what's important to us. But still, I mean, we just don't have, super crazy things going on this week. We do have the revised University of Michigan Consumer Sentiment Report coming out. We had the preliminary numbers. They were not great. So we will see what this revised survey says. It's just a survey. I want to say it's like 300 participants that they get. And it 800. My apologies. But, this is going to give a this is going to let us see how consumers are feeling about the overall economy and then inflation expectations. Last month, it was 6.7% for inflation expectations. Whew, that is fairly high. So let's hope not. Okay, let's see. So again, when we looked at the rates, I mean, as of April 17th, 6.83. It was 6.62. That's 21 basis points. That's a jump, and that's from that volatility I was telling you about. And that's what I'm saying. It's like if you find a rate, you don't want to be the guy that finds, a solid rate. Maybe it's not where you want, but I mean, where everyone wants is, no one wants to pay any interest, right? Everyone wants 0% interest rate. Not going to happen. But, people might be holding out and they're like, oh, the rates, I want a lower rate. Well, if you had the opportunity to lock in April 10th, sorry, because now it's up to 6.83. So not good. Let me see. Has this updated yet? Okay, we got quarter 4 of 2024. I think we're still waiting on quarter 1. Okay. So yeah, median sales price for the homes sold in the U.S., we want to see our home value still going up. I would assume no. I would assume that this quarter 1, 2025 is going to fall below 419,200. I think that's just from the inventory that's been sitting. I think that we've been living in a post-COVID world where values were inflated, and that may be coming down now. So, again, if you're looking to buy, then the data's really not against you too much. Of course, the interest rate's not great. Like I said, you can always refinance. You cannot get a new purchase price, right? That home that you really liked that was, I don't know, like $400,000. Maybe it's down to like $380,000, $375,000. These are things to be looking at right now. We're not going to try to call the top, nor are we going to try to call the bottom. We aren't going to try to call, this is the exact perfect time to buy. But you want to buy when you probably, if you're looking for a home and you're looking for a good deal, you want to buy when demand is low. When demand is high, of course, it's going to drive prices up. Again, economics 101, right? So when demand is down, that is when you want to buy. If you are able to work with the interest rate and you are okay with waiting for it to drop back down, it might be your time to shine. All right. That's all we got for this week. So we hope that you have a fantastic week. If you have any questions about mortgages, refinancing, maybe you want to pull out some of the equity from your home. We've been doing a lot of what's called HELOCs, home equity line of credits. Maybe you want to do a cash out refinance. Whatever you want to do, give us a call at 877-TEAM-MBL or find us at mortgagesbylinda.com and we will help you out with that. All right. Have a great week.